Welcome back to Investing with Confidence. As always, I am your host, Joshua David, and we are talking about the do's, the don'ts of the financial markets, doing some stock analysis. On the last section, we did Microsoft and Activision Blizzard, that blockbuster deal they were talking about this past week, and huge moves up for Activision to Blizzard. But Microsoft is on a daily downtrend, so it hasn't been doing so well, and that acquisition talk didn't really help it at all. So it's all about making smart investing decisions based off of price, not news. Because by the time the public, us, the retail investors, get the news, the moves have already happened. So we have to understand supply and demand, as we talked about in the last section, where to get in your positions before it actually happens. Mm-hmm. We talk about how institutions move price, how to find supply and demand zones in investing classes right here in Bloomington. Al, you teach these. I teach these as well, especially in the evenings. And if you want to come to one of these investing classes, just call 952-814-4410. That's 952-814-4410. Or you can also just go online to our website and register there. Go to otamin.com. That's OTAMINN.com. When you get registered for this class, we're going to give away something here. We've been talking a lot about stocks. We're going to give away some stock picks, and it actually explains and gives a vision on why this is an actual trade setup or potential market to get into. So, Al, as we talked about the gaming industry on the last segment, let's talk about that industry, or that company, I should say. Can we say it's roughly around a $3 trillion market cap?
We can say that because it is.
There you go. Huge company, great company, innovators. I mean, Apple iPhones, computers, AirPods, everything. I mean, you can't go anywhere without seeing something about Apple or somebody having
electric
Apple.
vehicles. Too.
There you go. Well, let's do some analyzing on Apple, and it's actually off its highs right now, down about 7% from its highs back from really the beginning of the year. And just looking at the price chart here, especially for our YouTube viewers, we have a nice demand zone where if price potentially goes down there's an area of interest where institutions have really moved that price, have consolidated and bought, potentially a lot of shares of Apple and moved it up to its highs. Now, as it's coming back down, we want to wait for price to come to us and then be buyers, not to buy at all-time highs. What are your thoughts on Apple? What do you see moving forward? Do you see the same demand zone that I'm seeing?
Yeah, absolutely. Apple is a fantastic company. We talked about it a little bit last week. They have so much cash on hand that even if they didn't increase their sales at all, they could continue to pay their dividend, I think, for the next 5 years. So it's a fantastic company, innovator. But here, one of the things that we think is really important is to look at something beyond just the fundamentals. Because when we're talking about, the cash that they have on hand, when we're talking about the PE ratios, we're talking about fundamentals. But let me just say that yesterday, on, let's say Wednesday, which was the 19th, I think of.
Wednesday was the 19th.
19th. Apple was down $3.57. That's 2.1%.
Yep.
The next day at 8:50 in the morning, it was up $2.38, up 1.37%. Did the fundamentals change overnight?
Probably not.
They did not change overnight. And we often say this, that for people that are looking for income, and that's cash that you need on a shorter term basis, not 5 years or 10 years down the road, but maybe weekly or monthly. If that's what you are interested in, if that's what you need, then fundamentals aren't really going to help you. It really gets down to this. If you want to be successful as a trader, you won't be unless you understand what the markets are telling you. How do you know what the markets are telling you? Well, for our students, we show them because the markets are telling us this on a price chart. You have to understand price action. You have to understand who controls it. You have to understand where it shows up on a chart. When Josh was talking about the demand zones and supply zones, a demand zone for our students taught in our core strategy is an area where there are buy orders sitting unfilled, getting ready to be filled. It's where the big institutions have shown us on a price chart where they're going to be active in buying something. A supply zone, that's where there are sellers. It's the opposite of a demand zone or a buy zone. So the supply zone is where we have identified institutional sell orders that are waiting to come into the market. That's how you become successful, is being able to identify those areas. Apple has been showing us that. We see a lot of these really great companies like Apple, Microsoft, NVIDIA that have taken a hit here over the last few weeks. They're maybe in a downtrend. That's a fantastic thing because they're not going to go to zero. They're going to go to a point where the buyers out there, the institutions that know the true value, are going to say, we have to get in here. This is a value we can't pass up, and they start buying. You should be able to identify those areas and be positioned already to be a participant when that happens.
Now that you're talking about that, I was just looking at the chart, and you were talking about short-term income potential in the markets.
Right.
When I talked about earlier, there's a potential demand zone roughly around the $150 mark in that area there. That was on a larger time frame, so longer-term investors would want to wait potentially until price gets to that bigger area. Well, you were talking about people are looking for income, whether it's, most people don't want to get a second job, but people are searching in the markets for that and to have that opportunity.
Right.
Well, looking on a smaller chart, as you were talking about on an hourly chart, 60-minute chart, there's actually a demand zone sitting right where it actually popped off of. So it was actually dropped right into that demand zone, an area of interest where institutions could be buying there, and it came right off that demand zone. So it's understanding and how to identify these opportunities. The price chart doesn't lie. It's telling you there.
Yeah.
That opportunity was actually created on December 7th. December 21st. I'm sorry. Yeah, December 21st of last year. So it was an opportunity that you just wait for price to come to there. So shorter term traders hopefully made investment decisions right there and caught that little pop where it's back up to $169 per share after that happened. So when Al was talking about institutions moving these prices, you have to identify that before it happens. And he was talking about core strategy. Online Trading Academy has a strategy that's designed to teach you to follow that big money, the smart money, to follow those institutional order flow movements in the market, but to do that with more confidence. And we talk about how that's done in these investing classes that we do right here on Bloomington. We have these classes during the week. We also have them on the weekend. And these are classes where we've taught thousands, just like you, are many strategies which are designed to teach you to make better investing decisions. So if you want to come to one of these investing classes, you have to call in. We're going to one of our reps will answer the phone and direct you to the right class that makes sense for you, whether it's on a Saturday or maybe it's during the week or even on the evening. So call 952-814-4410. That's 952-814-4410. And that's for 2 tickets for the investing class, also some free stock picks. And that'll help start to visualize what supply and demand actually looks like in the market. So, Al, we talked about Apple there, and I want to talk about the overall market. I think the S&P 500 really is the driver of the market. Anybody that's talking about the market is the S&P 500. So roughly that's around, let's look at the SPY, the ETF, which tracks the S&P 500. It trades just like a stock, roughly at about $457 per share, as far as, based on whenever you listen to the show here today. And I'm looking at this market, and it is also down from its highs. I'd say it's down about 5%. I think we talked about that in the beginning of the show, down roughly about 5%. And there's a demand zone a little bit lower, right around 436, in that area, and a supply zone at about 470. So there's areas of interest that I like to look at to make investing decisions. Now it's right in the middle. Do people? Is it the right thing to just wait until one of those opportunities show its face, or are you looking at are people just supposed to just buy right now and just hope that things go up?
Well, unfortunately, that's Unfortunately, that's what people do. It's not what you should do. Part of being successful as a trader investor is having the patience to wait until price comes to a level that shows you value on something if you want to buy, and also moves into an area where something is overvalued if you want to sell. So being patient is a big part of being successful. But it's easy to say, but I guess if you can identify where the buyers and the sellers are, it makes it easier to be patient because you know when those areas are realized for an individual stock or for the markets in general, that's where the greatest opportunities lie for you. The best spot for anybody to get into a position is at a turning point in price.
Mm-hmm.
If you can find that turning point in price, that is the lowest risk, highest probability of success, and the highest profit potential point that you can find. That's what our core strategy is designed to do. Now, the S&P 500, the reason that's kind of the benchmark that we look at is that it's comprised of 11 different sectors that really represent pretty much the entire economy.
Mm-hmm.
It's made up of 500 stocks, and it's had, even the S&P 500, even though it is diversified within those 11 sectors, we see this big movement. You know, you're looking at that price chart now. If you go back to January 12th, and you'll find a demand zone there that identified, I think it was around 472 on the SPY on the Spider.
Okay.
And the next day, on the 13th, it hit that level, went down, came back up, and hit that level. So there was an opportunity, and that really was at the point where the market started to roll over and start to go down. So you could have done a number of things to participate beneficially in the downward movement of it. You could have shorted the S&P 500. You could have bought an inverse ETF. You could have had an option position on there. Those are three different opportunities right there.
What's an inverse ETF?
It's the opposite of a regular ETF.
So does it track the market as it goes up then, or is it down?
It does exactly as it says. It goes the opposite direction. So there is an ETF, which is an exchange-traded fund, which for the S&P 500, that exchange-traded fund represents a portion or little bits of each of the 500 companies in the S&P 500. We talk about the Spider, the SPY. That is the ETF that mimics the S&P 500. There is an inverse ETF for the S&P 500 that goes the opposite direction. So if the S&P goes down 10%, that inverse ETF should go up about 10%.
So basically, you're saying if we have probably a lot of listeners that might think the market could continue to go down.
Sure.
Now they've been taught for so many years and conditioned for probably all their life. The only opportunity in the stock market is up. So you're telling me that there is an opportunity when markets go down to profit. Is that with that ETF?
Absolutely. And in fact, remember that the markets always go down faster than they go up. It's sort of like an escalator on the way up and an express elevator to the bargain basement on the way down. So you are in a position where you're either going to lose money fast in a down market, or if you know how to take advantage of down markets, you have the opportunity to actually benefit on a much faster basis. If the market goes down 3 times faster than it goes up, I mean, just do the math. You're either going to lose 3 times faster, or you're going to make money, or you have the potential to make money 3 times faster.
Yeah, it's all about having these strategies in your tool belt. I mean, you think of a carpenter. We get a lot of carpenters that come to these investing classes. Do they just have a hammer and a saw? No, they probably have a hammer, a saw, maybe a screwdriver, a tin snips. Gosh, it's been so long since I actually built anything. What else do they have? They have many tools in their tool belt.
Right.
Same thing in trading and investing. Up markets, there's opportunities. Down markets, there's opportunities. So if you're listening right now and you want to have more opportunity, you feel like you've been missing out on these, you got to come to one of these investing classes that Al teaches right here in Bloomington to talk about all the different opportunities in the markets, how you might be able to benefit in up markets, down markets, maybe even sideways markets, and it's having more strategies and more options in your portfolios. And that could be for income potential or your retirement accounts, 401ks, IRAs. So I want to give away some tickets to this investing class that he teaches right here in Bloomington. Call 952-814-4410 for 2 tickets. When you call in right now, you can receive 2 tickets. So you can bring a friend, plus some free stock picks. Call 952-814-4410. For those of you that like to go online, you can just go to otamin.com. That's OTAMINN.com and register there. We have these on the week. During the week. We also have these on the weekends, in the evenings as well. So pretty much anybody can attend these classes. 952-814-4410. Al, coming up next, I want to take a whole segment here on oil because it's been rising for a while, And I think people are seeing that at the pumps. Let's talk about oil and the XLV ETF, which is the energy sector for the stock market. We'll be right back.
Okay.